Well, today, you just think of the starting yield. And the starting yield today on the Bloomberg U.S. aggregate is 4.91%. That's the highest of the past year because yields have been rising lately. The starting yield, so think the year 2031. I could probably tell you in 2031, God willing, that the return that you had on bonds was, in the U.S. aggregate, was 4.91%. 94% correlation since 1978. So the starting yield is really important. It's the main determinant of your future returns, and so that's the thing I would focus on most is just simply getting that return. The rise in yields lately is another bite, provides another bite at the apple. Yields have been rising on and off for about 4 years, fluctuating. Some investors still stuck in cash, still stuck in low-yielding money market instruments in the mid-threes or so. When you could get yields between 5 and 7%, in portfolios, having an average credit quality is the key of AA-, which is to say a 99.98% chance of getting your money back, according to historical statistics. So the starting yield is a really important story right now.
Look at the first job, I think, for this guy, Tom. Trading assistant, guess where? Prudential Beige.
Prudential Beige. 115 Broadway, right next to Trinity Church.
Yep, absolutely.
It's a wonderful place to be, right near Wall Street.
Yep.
A room of stockbrokers, which today they call financial advisors. And I learned a lot from them, about 30 of them. And so today, these days, worldwide, I visit many financial advisors, again, that they once called stockbrokers, working for commissions. Today, it's a lot different. It's actually a good thing for investors.
Mike, in the fixed income world today, Tony, can I just clip coupons? That's a nice way to make a living.
Yeah, and here's another statistic. And looking at this yield where it is, the yields where they are today, and using the Bloomberg aggregate again as a gauge, and it can be mirrored worldwide. In a 1 year period, going back to 1978, investors 1 year later have made money 96% of the time. In other words, the return a year from now probably will be positive. So even if yields rise further from here, and they've been rising lately, that means bond prices could fall. The coupon, the income, is potent.
Okay. And the coupon of the 30-year oat in France, the gilt in the UK, even in the United States, gives pause. There's some superlatives like price back to where it was 2007, whatever. As you look at the global system, which you can do at PIMCO, bring that over to U.S. investors. Is it idiosyncratic or are they attached?
It's idiosyncratic, and that's why at PIMCO we've been suggesting sourcing duration globally, because the U.S. story isn't great necessarily on the fiscal side. We know the U.S. has a big budget deficit. It must continuously issue bonds, and that could result in yields rising. So we decided lately to source our duration globally, including in the U.K., for example, where yields are above that of the U.S., Australia, for various reasons related to the macroeconomic situation, in the emerging markets, where this year has been very fine performance, better than in the U.S., and it seems like the asset class is tending to fare better in the eyes of investors. So we think there are many idiosyncratic stories worth diversifying portfolio into.
Michael writes in and says he thinks the Fed's going to raise next week. What do you think?
We do not think so. Of course, Walsh isn't in the business of signaling things, but we think he would, perhaps if it were imminent. We're in the camp of the Fed doing nothing this year, but even if it hikes rates, and when I'm talking about this glorious bond market story, bond investing story, so what? And I think of Alan Greenspan, who I met years ago, very fortunate when he was an advisor to PIMCO when I worked in Newport Beach. He raised rates aggressively in 1994, battling the inflation fears of the late 70s, early 80s, late 80s, and he won. In his last 2 half-point hikes, the end of February of 1994 and then early 95, yields fell. So don't worry about hikes as a bond investor, because it actually it's medicine and it's tough love and it's a good thing.
Tell me here, generalist portfolio manager, somebody with a real job at the Pacific Investment Management Company like Jerome Schneider, exquisite at the short-term market.
The money market.
How's his year going? You know, I mean, Paul's talking about there's this wall of money.
Aggregate. Yeah.
Is the wall of money moving out of money market funds into the Jerome Schneider space?
It is. I'd say you should run from cash to core, but of course cash has its place. But another statistic would show that on a 3-year rolling basis that that core investments, meaning an average maturity around 5-6 years, or the Bloomberg aggregate around 6 years, 3-year rolling basis, meaning 3 years from now, should be able to tell you with 85% confidence that core beat cash. So it tends to beat cash, especially with yields in cash, high threes, the aggregate around 5, and high quality fixed income investments 5 to 7%. So you're probably better off shifting a bit from cash to core. So I'd say run, don't walk to that idea. Because here's one other point. And many Americans have, of course, locked in on a low mortgage rate. Americans should start thinking about joining what I call the double lock club. You locked in the low mortgage rate on your debt. Why not lock in a high interest rate on your fixed income investments?
How much credit risk should investors be taking on? I mean, the year to date, the high yield index on the Bloomberg terminals is performing the best.
It's winning. But these yields are good enough, as I mentioned, AA minus 5 to 7%. So you needn't stretch out into and go down in the capital structure.
Tony, thank you. You got a new book coming out?
I'm contemplating a seventh, a few different ideas. One is a novel called The Wall Street Tale, which will go back to my days. I worked, you mentioned Prudential Beige. After that, I worked at Lehman Brothers in the World Trade Center, 104th floor, some good stories.
Wow.
From an amazing view I had up there.